Hi, and welcome to Calamos Chart Talk. I'm Shawn Park, Director of Product Management and Analytics here at Calamos. In today's video, I'd like to take you through how adding alternative investments to a traditional asset allocation can lead to a more diversified portfolio and a better experience for your investors. Diversification at its simplest form is based on combining two asset classes with low or negative correlations, spreading risk across the portfolio. Of course, this is a basic example, and while the allocation has spread risk among equities and fixed income, it is still under-diversified. Equity risk dominates all three portfolios. Surprisingly, the portfolio with 70% fixed income has a high correlation of 0.87 to the S&P 500 over the same 20-year time frame. New portfolio building blocks are available, such as alternatives and multi-asset class products, to help construct portfolios that spread risk, increase diversification, and create higher probability of favorable outcomes, especially during market downturns. These new asset classes, when added to a traditional portfolio, can have a positive effect on portfolio risk and reward and downside protection. In addition to using alternatives to lessen the impact of equity volatility, alternatives can also be used to help address one of investors' biggest concerns today: an eventual Fed move to raise interest rates. Certain types of alternative strategies can be used as enhanced fixed income allocation that diversify a traditional fixed income asset allocation and mitigate the risk associated with a rise in interest rates. To illustrate how alternatives can add value, we created an allocation that includes a 20% mix of alternatives. When adding this sleeve to the original allocations, the new portfolios move up and to the left on the chart, indicating a more efficient allocation has been created, with lower risk and higher return expectations. Depending on an investor's risk tolerance and investment objective, an allocation of 10 to 20% in alternatives may make sense in order to have a meaningful impact. This may seem high, but consider that many investors subject their asset allocations to large exposure to long-only equities across the globe, which during financial stress become highly correlated, exposing them to potential large drawdowns. In conclusion, diversification is still an important tool for asset allocation. Portfolio construction has become more complex, and investors should reconsider their approach to building diversified portfolios. One approach they may consider is diversification of risk by utilizing new asset classes such as alternatives, which help to minimize downside risk and further diversify portfolios. Thanks for joining us today on another installment of Calamos Chart Talk.